Yes, it's
Okay,
clear.
good, good. Okay, a short introduction of myself. Okay, my name is Li Eng, and I am the Assistant Director of the Small Business Division in IRAS. Okay, I am in the Business Operation Branch, and in short, we call it BizOp. Okay, so BizOp branch administers the income tax matters for small businesses, and it includes sole proprietors, partners, and partnership. Okay, so in today's course, today's topic is actually taxation of businesses. I'll be sharing with you the tax treatment and rules applicable to a self-employed person. Okay, so we have touched on who is a self-employed person. Self-employed person is basically an individual who earns a living by carrying on trade, business, profession, or vocation. He can be a sole proprietor or a partner of a partnership. Next, I will touch on the tax administration of the self-employed person and things like deductibility and non-deductibility of expenses. Although Serene has touched on it earlier on, but there may be different type of expenses because self-employed person, basically they are the owner, okay? So they could have incurred more expenses than a normal employee. Okay. So I'll touch on the deductibility of expenses and also the MediSave CPF contribution that a self-employed person need to contribute, and also the tax treatment of unabsorbed trade losses and capital allowance and even carryback relief system. Okay. Okay. In addition, we'll be looking at the different partnership structure. Okay. We have the general partnership, we have the limited liability partnership, which is called LLP, and a limited partnership LLP. And also, I will explain terms or concept pertaining to LLP's relevant deduction restriction. This is important. It's very critical because it helps in the computation of accessible income of partners of LLP. So do pay more attention to the illustration as I go through so that you can understand better the topic. Okay, then okay, personal relief and rebate, Serene has already touched on, so I will not be touching on that in this module. And we will have two short breaks in between. After the self-employed, the sole proprietor section, we will have a short break. Then we will come back to do the partnership. Then after that, we will have another short break, and we will go on to the case studies. Okay, I should emphasize a bit on the case studies because case studies are actually very important, because the earlier part is more on theory. I go through the slides, and then if you've got questions, I will answer the question. But as what Serene already explained, that because we have a certain timeline, I mean that we have to follow the time, so we will take the question after the slides. So yeah, the case studies are important because it gives you a better understanding, okay, of what the theory part of it, and then you will have a better grasp of the LLP loss restriction concept. Okay. Okay, good. I will go on and start the training. Okay, module 4. Sorry, it's blocking me. Okay, so we have this sole proprietorship. Okay, so proprietorship is actually a business, okay, the business entity. So the owner of the business is the sole proprietor. So the sole proprietor is one who owns the business and earns a living by carrying on the business. Okay, the income of the sole proprietor that he earns from his sole proprietorship business is his business income. And we're going to assess it to tax in the name of the sole proprietor. So basically what we are saying is that for sole proprietorship, the business entity, we won't be taxing that, but we tax it in the hands of the owner of the business, which is the sole proprietor. So the sole proprietor is an individual person, it can be a corporate entity. So taxation is in the hand of the sole proprietor. Okay. So a self-employed person is one who carries on trade, business, profession, or vocation, he is not an employee. The earlier module, Serene already explained how we differentiate employees from self-employed person. Okay, so this section we are talking about is self-employed person. Okay. So self-employed person is okay. A sole proprietor is self-employed person. There are other self-employed persons who carry on profession or vocation. So they're basically independent. Okay, like independent commission agent. We have lawyers, doctors who are not under employment but doing their own practice. Okay, so they're all classified as self-employed person. Okay, when we look at the income of the sole proprietorship, okay, we know that we're going to assess in the hands of the sole proprietor. Then how are we going to assess in which YA? I think by now you all know that income tax is assessed in a preceding year basis. So for businesses, they can have accounting period and they can be on the calendar year basis or accounting year basis. So you look at the end of the sole proprietorship accounting period. So for this business, if the accounting period is on a calendar year basis, that means January to December, then we look at December. Okay, you look at the table, 31st of December 2022. This is the end of the partnership, the sole proprietorship accounting period. So income will be taxed in YA 2023. Okay, YA stands for year of assessment. I think by now you all know. Okay, so we call it YA 2023 because the end of the sole proprietorship accounting period is on 31st of December 2022. Okay, what happened if the business accounting period is accounting year? Accounting year can be any other dates. Okay, it can be like in this example, 1st of April 2022 to 31st of March 2023. Then the end of the accounting period is 31st of March 2023, right? So we see 31st of March 2023, income will be taxed in YA 2024. Okay, so these are the business income of the sole proprietorship business. How about the non-trade income of the sole proprietorship business? Okay, so if the business has non-trade, maybe rental income, then this non-trade income derived from the sole proprietorship business will follow that of the trade income of the business, which means to say, if the business is on accounting year basis, the non-trade income that the sole proprietorship business derived, it will be assessed on that same basis. It follows that of the trade business of the business, trade income of the business. Okay, I shall move on to the next slide. Okay. So, as I said, the sole proprietor is an individual. So this individual sole proprietor, he may have other income. Okay, other income other than from this business income. He may have employment income, he may have a partnership income, he may have rental income, he may have any other income that we're going to assess him. Okay, so what happened is that this other income that is non-trade, like employment income, just now we touched on employment income, will be assessed on calendar year basis, strictly on calendar year basis. Okay, so for the sole proprietor himself, the individual, say Mr. A, he's a sole proprietor. This Mr. A will receive an income tax return form B. Okay, this income tax return form B is for him to declare his income from all sources. Okay, if he is a sole proprietor of a business, a partner of an LLP, an employee of a private limited company, then he has three types of income already. All these three types of income he has to declare in his income tax return form B under sole proprietorship income, partnership income, and employment income. Okay, so just bear in mind that individual sole proprietor or self-employed person will receive a form B and he's supposed to declare his income from all sources in his income tax return form B. Next. Okay, next I will briefly explain what is partnership. Okay, so partnership is where two or more persons come together to carry on a business with a view to make profits. Okay, so the different types of partnership, we have general partnership, we have limited liability partnership, we have limited partnership. Okay, each of this partnership, I will explain more in the later slides. Okay, you need to know that for income tax purpose, when we talk about partnership, it is actually tax transparent. What do we mean by that? It means to say we do not tax at partnership level, but we tax income at the hands of the partners. That means the partnership will derive income, then we share it. How the sharing is made among the partners, and once the partner has this amount of profit, sharing of profit, it will be taxed in the name of the partners. Are you hearing me well? Because I'm not too sure. I can't really see.
Yes.
Yes, yes.
Can because I
Yes, yes.
I can't really see whether there's anything. Sorry, let me just go on to the next one. Give me a bit of time. I try to navigate. Oh, okay. I can see. Okay. Okay. So next, I will be looking at this taxation of sole proprietorship and partnership. Okay, so this is just an overview. Okay, overview to say that in the next few slides, we'll be touching on sole proprietorship and partnership. We'll be looking at deductibility of expenses and capital allowances claim. We're looking at donations, carried forward, carried back, unabsorbed losses, CA, etc. Okay, this will be in the later slides. This is just an overview. Next, oops. Full screen. Okay, so next we talk about deductibility of expenses. Okay, so this one we have it is the renovation and refurbishment. Okay, in short we call it R&R. So as a self-employed person, he will incur quite a number of expenses lah. Okay, rightfully speaking, renovation and refurbishment is more capital. Okay, but in the Income Tax Act, we have it under Section 14 and specifically allowed. Okay, so when you talk about expenses, you'll be looking at Section 14 and Section 15. Basically, Section 14 will allow you, what are the expenses? It must incurred wholly and exclusively in the production of income, whereas Section 15 states what are the prohibition that means cannot claim. So you have to look at these two sections together. So R&R cost is in Section 14 and deduction, so we can allow. Okay, so self-employed person may incur expenses, R&R works carried out on his business premise. So we're going to give him deduction. Okay, how are we going to give him the deduction? Is over 3 consecutive YAs on straight line basis. For instance, if he incurred 90,000, okay, R&R cost. So 1 year he divide by 3, 1 year will be 30,000, the following year 30,000, and the following year 30,000. So 3 years, over 3 years, we allow you this deduction. IRAS will allow this deduction. Okay, that's a cap. Okay, the expenditure cap is 300,000. Okay, and it's at the individual level. Okay, so regardless how many businesses he has, it will be at the individual level 300 expenditure cap. For partnership, you'll be at partnership level. Okay, the next slide will show you more. Okay, you will have a better understanding what do you mean by the 300,000 cap. Okay, another thing to take note is that for YA2021 and YA2022, we have this I&R cost that is accelerated faster. Instead of 3 years, you can claim it in 1 year. And this is only for YA2021 and YA2022. Okay, and it comes back again in YA2024. So YA2023 don't have. Okay, YA2023 is only 3 years. Okay, I think there was one question that was being asked about the examination. Okay, so the examination is on YA2023. So we will not be touching on, at least the question won't be on 2024. So just pay more attention to the YA2023's condition. Okay, now I go on to the next one. Okay, so this is what I mean by the expenditure cap of 300K. Okay, this is more visual. Okay, you look at it, you have a better understanding. So you see, this individual is both a sole proprietor and a partner. So what happened if he incur renovation and refurbishment costs, R&R costs? So you look as an individual A, he has 3 businesses. Okay, but the cap will be at individual level. So the 3 businesses, you add up together, the maximum we can allow is only 300. The cap is 300. But separately, he has a partnership one. So that partnership itself stands alone will have a cap of 300,000. Okay, I move on to the next slide. Okay. Okay, deductibility of expenses. Another one is the Enterprise Innovation Scheme, EIS in short. Okay, this is effective from 2024. Okay, so it's a topic that is not covered under examination, but it's a good information for you all to know. So what is this EIS? Okay, so EIS was introduced in budget 2023. Okay, basically is to encourage businesses, to engage in R&R, innovation, and other capability development activities. So it's quite similar to PIC, if those of you remember, okay? So we have this enhanced deduction or allowances, which is very attractive. It's 400%. You can claim up to 400% of the cost, and it's capped at 400,000. Okay, so this is the deduction. There's another one in lieu of deduction. Taxpayer, self-employed taxpayer may want to get cash payout. Okay, so cash payout is at the conversion rate of 20%. That means the cost that you incurred times 20%, that will be the cash payout. So taxpayer has a choice. Self-employed taxpayer has a choice whether you want to claim the 400% deduction or you want to get cash payout. Okay. More details on this are actually found in module 2, okay, the corporate tax. Okay, this is an important topic. The fixed expense deduction ratio. Okay, yes, because this one basically help SEP to to file their tax. Okay, to simplify tax filing, because there is a ratio given to 3 main groups of self-employed person. Okay, the ratio is accordingly to who are they. If there are private hired car drivers, it will be 60% of the gross driving income. If they are commission agent, it will be 25% of gross commission agent. If they are delivery workers, it will depend on the delivery mode. So it's only open to these 3 groups of self-employed persons. And what do we mean by fixed expense deduction ratio? As the name said, it's a deduction, it's a ratio, it's a deduction ratio. So when we say like private hire car, 60% of gross driving income, it means to say that you have maybe 100,000 your revenue, your gross driving income is 100,000 for that year. Then 60% is deemed as your expense. So 60,000 is your expense. So left with 40,000. So straight away, you can claim 60%, and we tax you on the 40%. Okay. So it helps taxpayer in that sense that he can adopt this FEDR, opt for this FEDR, and have this fixed expense deduction ratio instead of claiming actual expenses. Okay, I move on to the next slide. Okay, we are still on this private hire car drivers. Okay, on the expenses claim. Okay, I think by now you all know that private car expense are not allowable. Okay, so if the person, a self-employed person, is a commission agent and incurred expenses on his private car, the expense on the private car is not allowable. because it's prohibited under Section 15. But there's something which you need to take note of, that is Section 14ZA, which we allow private hire car drivers to claim tax deduction on the car. And that is only effective from YA 2019. Okay, so specifically, we have this section that's given to private hire car drivers. Okay, so for private car drivers, if they have car-related expenses, okay, they can claim, and it's only to them only, not to any others. But the purchase cost is definitely not allowable. It's a capital expense, and there's no capital allowance to be given as well. Then, if this private hire car claim actual expenses, and the expenses is more than the income, there's a loss. Okay, this loss cannot offset his other income. Other income like his employment income, it cannot be used to offset his other income. Should he have a loss in respect of his private hire car earnings. And if the car, if he's both, he used for some private use, okay, and as well as private car hire, private hire car driver earnings, then the expense have to be apportioned accordingly, okay, because the private elements is not allowable. We can only allow the business part of it, okay, the part that's pertaining to earning the private hire car drivers earning income. Okay, now I move on to the next slide. Okay. How come I cannot click on? Oopsie, why it's stuck? Okay, can. Okay, just now I've been talking about the FEDR. Okay, so right now we have examples with numbers. So examples are always very good, because it gives you a better understanding. Okay, so we have this case where taxpayer, self-employed taxpayer is a private hire car driver. Gross passenger fares 80,000. Incentive, rebates, promotion, miscellaneous payments 20,000. So total all in 100,000. 100,000 is his income derived as a private hire car driver. If he wants to opt in for FEDR, then it will be at 60%. 60% is the deemed expenses. Okay, 60% deemed expenses. So 60% of 100,000, the expenses would be 60,000. 100,000 minus 60,000, his net income is 40,000. So 40,000 will be accessible to income tax. So it's simple. He just say, I want to opt in. I want to be in this FEDR. I don't want to claim actual expenses. I'm happy with the 60% deemed expenses. I will be taxed only on 40,000. Okay, I move on to the next one. I got problem clicking. Okay, can. Okay, just now I mentioned for FEDR only 3 groups of self-employed person. So one group is the private hire car drivers, another group is the commission agents. So commission agent is the second group. Okay, for commission agent, they can claim 25% of their gross commission income as deduction. So the FEDR is 25% of their gross commission income in lieu of actual expenses incurred. And who are the commission agent? Basically, self-employed person who are getting commission, insurance agent, property agent, MLM, remisiers. So they all fall under commission agents. Okay, there's certain conditions to it. They must be tax residents in the YA relating to the tax period. They must be carrying on trade, business, profession, or vocation. That means cannot be employee. It must be independent, derived income as a vocation, as a commission agent. So there's another thing to take note of is for commission agent, the income cannot exceed 50,000. Earlier on, private hire car driver there is no income threshold. Okay, as long you're a private hire car driver, you can opt in for this FEDR. But for commission agent, there's an income ceiling. Your income is only up to 50,000, then you can opt for or elect for this 25% of FEDR. Okay, so anything below 50 and below can. Anything above 50,000 cannot. You have to claim actual expenses. Okay, so basically FEDR makes it easier, but taxpayer, like for the private hire car driver, if they think that their actual expenses is higher, they can actually claim expenses and not claim under FEDR. So it's actually an option. Okay. Just now we mentioned about commission agent, the cap of 50,000. This slide will explain, okay, what do we mean by 50,000 cap, 50,000 K cap on the income. Okay, you see agent A and agent B. Agent A is an insurance agent as well as a remisier. So his total commission for that year is 41,000 plus 7,000. So it's 48,000. Okay, so when we look at commission income, we look in totality. Okay, agent A's total commission income is 48,000. So we don't look at whether it's an insurance agent or remisier, but we look in total, what is his commission income. So his commission income is 48,000, he qualifies. So he can opt for deemed expense ratio of 25%. If he wishes to lah. Okay, it makes it easier if he say yes, I want, then simply 48,000 times 25%, 12,000 would be his business expenses. Okay, and this will simplify his tax filing. He will just put in 48 and wants to claim for FEDR, and then the net income is the 48 minus 12,000. That will be his net income, which will be subject to tax. Okay, now we look at agent B. Okay, agent B, he's an insurance agent as well as a real estate agent. 55,000 commission, 55,000 commission as a real estate agent, 12,000 commission as an insurance agent. Okay, the total definitely more than 50K. In fact, if his real estate agent is 45, total also more than 50,000. So as long as his income, commission income is more than 50,000, he is not qualified. He cannot say, I want to opt for FEDR because his income is more than 50,000. His commission income is more than 50,000. He has no choice but to claim actual expenses, keep proper records, keep receipts, then list down all the expenses, and then add up all the expenses, and then minus from his commission income. The net income will be subject to tax. Okay. So next we have this. Okay, the next group is the delivery worker. Okay, this is only effective from YA2024. So YA2023, we don't have this. It's only in YA2024. Then self-employed delivery worker can claim 20%, 60%, 20%, 35%, or 60% based on what mode of transportation. Okay, so you see, if it's van, naturally there'll be more cost, right, for the van. So it's higher, 60%. It will be the FEDR. If it's public transport or even on foot, it's only 20%. So according to the mode of transport. Okay, you can see that there's also this 50,000 cap there. So it's similar to commission agent. For delivery worker, if his income is up to 50,000, he can opt for FEDR. If his income is more than 50,000, he cannot opt for FEDR. He has to claim actual expenses. And also remember, this is only for 2024. Okay, 2023, no choice, claim actual expenses. So far, are you okay? Yeah, move on. Let's see. I think how to go back? How do I cannot see slide? Okay, can. Okay, now we touch on section 15. I think by now you all will have some understanding on deduction already, right? Okay. Anyway, section 15 are those that are not deductible. Okay. So basically they are private personal expenses. There's nothing to do with business, nothing to do with the earning of the business income. It's all private expenditure. Okay, own expense, own the sole proprietors, his own meals, his own personal expenditure. So these are all private expenditure. Okay, so all private and personal expenses are not deductible, and we give some examples, like the his own home. Okay, maybe he some on any outgoings on the premise that is used as residence, so proprietor's own salary, his CPF contribution. Okay, and by the way, his own salary he cannot deduct, because whatever income he's earning is already his income, so he cannot further deduct his salary as expense. The only deduction for salary is staff salary. If he has staff, if he employed staff, then it's part of business cost already. So the staff salary, the sole proprietor can deduct that expense, but his own salary cannot. Is considered as private. Okay, private car expense, I think I already explained enough already. The only exception is private hire car drivers. Other than that, cannot allow private car expenses. Okay, family members, medical and insurance costs, holiday expense, all these are private, nothing linked to the business, so cannot allow as well. Drawings, his own personal drawings from the business, they are also not allowable. Okay, next we touch on MediSave. Okay, for self-employed person is it's a bit unique in that sense lah, because they are unlike employees where there's some compulsory contribution. Okay, employer got to contribute, employee also got to contribute, but self-employed, the only compulsory contribution, at least at this moment, is MediSave contribution, and MediSave contribution applies to self-employed person who are, you need to have two conditions. Okay, very important to bear in mind what are the two conditions for self-employed persons to make MediSave contribution. And they have to be Singapore citizens or PR. That is the first condition. And the next condition is that they must have net trade income of more than 6,000 in a year. Bear in mind net trade income, which means to say revenue minus expenses, that is the net income. So net income of more than 6,000. If net income is 6,000, no need in that year. If net income is 6,000, no need to contribute MediSave. If net income is 6,100, he is a Singapore citizen, then he has to pay MediSave. And how much MediSave he needs to pay? That is the table there. It depends on the net trade income. It depends on his age as well. So if he is below 35 years old and his net trade income is above 18,000, he falls under the 8% MediSave contribution rate. Okay, so 8% of net trade income, it come up a certain figure, but the maximum MediSave that he needs to contribute is capped at 5,760. Okay. Okay, then talk about relief because he need to contribute to MediSave. So self-employed person can also claim CPF relief. MediSave CPF relief. Okay, what is the quantum? How much we're going to allow as tax relief? Okay, the three figures are important. You have to know that you need to have actual MediSave contribution in order to allow you to the relief. So what is the actual MediSave contribution that was made? Then look at 37% of net trade income. Then look at 37740, which is the ceiling. Okay, so the lower of any of the three, that will be the amount of tax relief. Okay, the next slide will show you an example. Okay, here we compare the three items of the CPF relief allowable. The lowest of the three, 37% of the net trade income, the 37740, or the actual contribution. Okay, John is a 30-year-old self-employed person. His net trade income for 2022 is 110,000. He has to make mandatory MediSave contribution, and that's the max, the 5760 based on his age and the net trade income. So he has to make 5760. Okay, he can make voluntary CPF contribution. We can allow him CPF relief if it's within that following 37% of not yet income or 37740, which means to say if we look at 37740 because 37740 is the max. 37740 would have included 5760 because that is the MediSave contribution. So 37740 less 5760 will be minus 57 will be 31980. Okay. Then we look at 37% of 110 is 40. So 40,700 compared with 31980. 31980 is lower. So he can contribute up to 31980 for his voluntary CPF contribution. Okay, next we go on to the expenses. Okay. Okay, so proprietor Mr. S has deducted the expenses below in arriving at his net profit for the year ended 31st December 2022. Which of the expenses have to be added back in computing his adjusted profit for YA 2023? You see, for self-employed person, they can claim anything they want to, but we are governed by Section 14 and Section 15. So we have to take a look. What are the list of expenses that we can allow, that is allowable deduction, and what are not allowable? So first of all, we look at it. Upkeep of private motor vehicle prohibited under Section 15, so add back. Mr. S is not a private hired car driver, so we cannot give private car expense, so add back. Depreciation is also not allowable, okay, so we have to add back. Training costs for staff, these are considered part of staff costs, part of business costs, so it's allowable. Training costs for Mr. S himself, no. Okay, so the gist is that anything that is likely pertaining to Mr. S as a sole proprietor, those are likely to be personal. Okay, so his own training costs cannot allow. Okay, R&R cost, just now we talked about it. YA 2023, we allowed the cost to be in 3, divide by 3 over 3 years. So the full cost, we have to add back, but allowed 1/3. Okay, the first YA 1/3, second YA the next 1/3, the third YA the next 1/3. Because YA 2023, it has to be over 3 years. Laptop for business use. Okay, it's actually not allowable, but we can give capital allowance, 100% capital allowance. Okay, okay. iPad for his second child's university study. I think quite clear. This one nothing to do with business. This is his child's iPad that he bought for his child. Definitely not allowable. Contribution to Mr. S MediSave account. he make his own CPF contribution, also not allowable. But we may consider CPF relief. Okay, this is another section. CPF contribution for staff within statutory limit. Okay, so it's nothing as excessive. Yes, we can allow. This is all part of staff costs. Then we have allowance and salary for staff. Yes, staff costs allowable. Okay, salary and bonus for Mr. S. Again, his own salary cannot deduct. Okay. Fire insurance for office premise. Yes, can, because this is the office premise. Is incurred in the production of income. He need to work in the office. He need to use the office. So fire insurance, yes. But life insurance for himself and for his wife, no, these are definitely private. Airfare for overseas business trip. This one we take it as for business trip lah. Okay. Of course, the quantum may be another issue, but the nature of it is business trip. We take it, we will accept it. Okay, withdrawal of capital, definitely no. Okay, it's capital withdrawal. So then we can give 1/3 for R&R, and we can give CA 100% for laptop. Okay, sorry, I've got to be mindful of the time. Okay, I got a few more slides to go before a bit overrun. Okay, go on a bit faster now. Okay, so you see, for self-employed person, they are for self-employed person, they are slightly different from employee because they will have losses. And if they have losses and they have CA and the CA are unabsorbed, what happened to it? Okay, so the self-employed person can actually carry forward CA, capital allowances that are not utilized, that are not used up in that YA, and carry forward to the following YA. Similarly, for trade losses, they also can carry forward. But for CA, there's a condition. When you carry forward the CA, make sure that the same business continues in the following YA. Approved donation can carry it forward up to 5 YA. Okay, the order of the CA is the order of the deduction, the order of the deduction, the offset rules, first capital allowance, then trade losses, then approved donation. Okay, next one. Okay, so you can carry it forward, you can carry it back. So carry back is subject to a certain quantum, which is 100,000, carry back to the preceding YA, and make sure that the preceding YA indeed has accessible income. Okay, it must have income for you to utilize this loss of this CA to offset against the income of the preceding YA. Okay, carried forward and carried back for CA, there is this same business test to be satisfied, which means to say that if the person just commences business in a particular YA, say YA 2023, then he has losses. He cannot carry back to YA 2022 because he just commenced. At least for losses can, but for CA cannot. Okay, CA is subject to the same business test, the business continuity test. So in 2022, he has no business yet. He only started in 2023, YA 2023. So if he carry back, he can only carry back losses, but not the CA. Carry back relief, yes. So this is talking about trade losses, as what I just mentioned. He can carry back trade losses because it's not subject to business continuity test. So if he just commences business, he can still carry back the trade loss. Yeah. So CA, just bear in mind, for CA is always subject to the business test, the same business test, whether is it forward or is it back. Okay, carry back relief, this is more for your information because it's for the YA 2021 and the YA 2020, we have such thing as enhanced. Okay, enhanced means increase from 1 year, carry back to the immediate one, you can carry back 3 YA. Okay, so the order the carryback is stated down there, but this is past already. 2020, 2021. Now 2023, no, only carryback 1. Okay, so for your information. Okay, this is on oopsie, this is on partnership. Oh, sorry. I'm trying to see. Okay, I think Jean asked about training costs for business purpose. No, anything that's pertaining to the self-employed, no. Okay, we cannot allow only staff costs, then we can allow. Okay, I think before I move on to partnership, we will have a break, maybe 10 minutes break. Then I move on to partnership. But I think there is one question which maybe I should answer here. I think Jean, you asked about resident that was asked earlier under Serene's topic. You're talking about for tax resident, income received through partnership is not tax exempt. Why? uh, I think just now earlier on we mentioned about individual, okay, individual resident, foreign income that is remitted into Singapore. When we say receive in Singapore means remitted into Singapore. Foreign income that's remitted in Singapore is tax exempted, but not through partnership. This is correct. It's not through partnership. So what you have stated down there, um, for foreign income that is received in Singapore through a partnership is not tax exempt. The very reason is that under Section 13, it specifically state exclude partnership. So it's in the Income Tax Act. But if you look further, you can see under Section 13(8), they do say that there are certain conditions which it can be exempted. Okay, it can be exempted under Section 13(8). If you want more information, because it's not covered in the topic, okay, in this topic here, if you want to know more information of foreign source income exemption, there's an e-tax guide in IRAS website, which you can go and take a look. Okay. SMC cannot deduct. Okay, why not we go for the break first? Now is 12:19. I overrun a bit already. Okay, 12:30 we come back, then we will touch on the partnership. I would like to have more time committed to the case study because the case studies are very important. And for case studies, I want at least help me to be more interactive and participate and give me the answer, and then we can work together. The answer may be wrong, it's okay, but you learn from the wrong answer. I will tell you why is it that it's not the answer, why is it that it's this answer. So that one will be later on, but I would like to have more time on that. So we have a maybe 12:30 we come back, we start on the partnership. Then after that, then we will, after the partnership, then we do the case study. Okay, so can I have Tax Academy to help me to put this timer now?
Yeah, sure. I'll do that
Okay,
now.
thank you.
Okay.
Hello. Yep, yeah, all back already. Okay. Oh dear, my screen, y'all don't see my sharing already, right?
No.
Oh dear, how do I get
You
it?
have to share your slides again.
I share my slide again.
Yeah,
Okay.
correct.
I need to exit. Okay. Wait, okay.
Yeah, I see your.
So I will go to we stop at slide 28. Slide 29 should be this one. Okay. Okay, so you all have the slide. You all can see the slide, right? Okay, good. Okay, so now the next portion will be on partnership. When we talk about partnership is when two or more people come together and then they agree to share on the profits and the loss. Okay, so what sort of partners are they? Okay, so they can be limited partner, they can be equity partner, they can be salary partner. Okay, equity partner are usually those who contributed a fixed amount of capital and has a share of the partnership profit and loss. And usually they should be unlimited liability to the partnership debts. Whereas limited partners are different. Okay, they are limited means to say that they have they are not they are not liable for partnership debts that is beyond what they have contributed as capital. That's why they are limited. And these limited partners later on in the slides, we will have to look at the losses. Okay, the losses from the partnership. And this is a very important concept on the loss restriction that we can allow against the other income of the partner. Other income of the partner, yeah. So this loss restriction, we will have the case study on it. Okay, so later on we will touch on it. And for salary partner, they are usually like employee. They could be even under a contract of service. That means they are getting a salary just like any other employee. Okay, next. Okay. Resident status. Okay. Just now we touched on resident status of individual. Serene already explained that we look at Section 2 of the Income Tax Act. Okay, for partnership, if you look at Section 2 of the Income Tax Act, you'll notice that it covers individual, partners, and bodies of persons. And individual definitely it covers individual. So partnership definitely not individual. Partnership is not company and covers a body of person. Who are these bodies of person? So when you look at the Income Tax Act, you will see bodies of persons specifically stated down there. It does not include a company or partnership, which means to say that partnership there is no resident status. Okay. Uh, so no certification of tax residence of a partnership since it's not a legal person for income tax purpose. I think earlier on I already explained that how we tax is that we tax the profits in the hands of the partners. So when we talk about resident status of each individual partner, then it will be different. It will be the individual partner level. Okay, so it's not at partnership level. Okay, assessment of partnership income. Okay. Okay. For this particular slide, take note that precedent partner is responsible for filing of the partnership return. Okay. Partnership return is called Form P. Okay. Partnership needs to file a Form P. And the filing of the Form P is the responsibility of a precedent partner. Okay, so basically what it means is that the precedent partner will take the form P, either e-file or file physically, declare the business performance of the partnership, the four-line statement, declare the adjusted profit, how is it being shared among the partners, and individual partners, how much will they be getting from this share of profit. So that will be in the Form P, and it's the responsibility of the precedent partner to file the Form P. So if the precedent partner has his own maybe another trade, sole proprietorship income, so he would have his own Form B. So precedent partner will have his own Form B. He will have to file his sole proprietorship income in the Form B under trade. He will also have to file the partnership income in the Form B, which means to say that precedent partner has to file two forms, two income tax return forms. One is the Form P for the partnership, and another one is his own individual Form B. Okay, move on to the next one. Okay, then who is the precedent partner? Precedent partner is defined under Section 71 of the Income Tax Act as someone who is first named in the partnership agreement. In the absence of partnership agreement, it will be specified by name or initial. Okay, is the precedent acting partner if the precedent name, if the partner name with precedence is not an acting partner. Okay, in practice, if the partnership file a tax return form, the partnership can just state who is the precedent partner. That means the precedent partner can say that, okay, so and so is, or I am the precedent partner, and we'll accept it, we'll take it as it's agreed among all the partners that this particular person is the precedent partner. Okay, filing of the partnership returns and accounts. Okay, just now I mentioned that precedent partner has to file a Form P, and in the Form P has to give us the four-line statement. The financial statement is not required if it's less than 500K, 500,000. So partnership with revenue less than 500,000 will need to file a four-line statement and need not give us statement of accounts. Okay, just the four-line statement, which is the revenue, gross profit, allowable business expense, and adjusted profit. If the partnership's revenue is 200,000 and less, they only give us two line, okay, which is the revenue and the adjusted profit. Okay, that is how the filing of Form P. And it's only for those partnership with high revenue of 500,000 and above, then have to file a Form P, and at the same time must give certified statement of accounts. When we say certified statement of accounts, it's basically just the precedent partner sign to say that I certify true and correct. Okay, allocation of profit. How do we allocate partnership profit? Okay, so as we know, because at the partnership level we don't tax, we only tax once it's allocated share of profits, tax in the hands of the partners. So how would we allocate? Okay, first of all, we take note that it has to be adjusted profit. Adjusted profit means we have to add back disallowable expenses, and then we derive the adjusted profit, because in the P&L it could be any expenses is there, but certain expenses are not allowable, which we have gone through. Then we will have add back, then we come adjusted profit. From the adjusted profit, you have to look at what are the fixed payment. That means regardless whether the partnership is doing well or not doing well, partners may be entitled to certain payment, like partner salary or even interest, okay, because they contributed capital, so they got some interest. So these are so-called fixed payment. So we have to take note of what are the fixed payment, then remaining, okay, will be the profits or the loss to be divided among the partners. Okay, you may not understand fully, but we go to the example. The example will show exactly how the allocation of profits work. Okay, what happens if there's no written agreement? Similarly, we need to allocate to the partners. So it's based on consistently adopted. Every year is consistently adopted and is agreed, even without written agreement and some reasonableness. It's like the partner who contribute more capital likely should have a higher share of profit, you know, or the partner who does more thing, more work, you know, so should be given a larger share of profit. So something like that. But in any case, the partnership profit has to be distributed, has to be shared among the partners. Okay, next we take a look at this example. Okay, as I said, example is always good. Okay, because example will give you a better understanding of how to do things, and especially for this, you will see how we're going to allocate the profits from the partnership. Okay, so we have this adjusted profit is 24,000. Then we have salaries to partner A and partner B. So there's only two partners in this partnership. So these salaries are actually fixed, regardless of the performance of the partnership. Is paid to them. Okay, paid to them 6,000 to partner A, 4,008 to partner B. Then there's an interest of 5% that is payable that they will receive, they can expect to receive, which from the partner can expect to receive on 5% of their capital put into the partnership. And then there's a sharing basis. Okay, sharing basis has been agreed that it will be 2/3 for partner A and 1/3 for partner B. So we have the amount of capital that was contributed, which is 20,000. Okay, so we see how shall we do. Okay, I think I show everything first, then I explain. Okay, just now remember I told you all adjusted profit is 24,000. So we have this adjusted profit 20. Oopsie. Just touch something and it goes to the next slide. Okay, adjusted profit 24,000. Okay, this is as per the example. Okay, then we look at what are the fixed item, fixed payment. Okay. Fixed payment are salary, 6,000, 4,008, which partner A and partner B can expect to receive. So in total is 10,800. This is fixed. There's another fixed payment, which is the 5% of the capital. So according to their capital contribution, they are entitled to 5%. So we have 1,000 and we have 800 for partner A and partner B respectively. So in total, we have 1,008. So 24,000 is the profit. We have to less out the fixed item, the fixed payment, 10,800 and 1,800. Then whatever remaining is something that can be divided according to the sharing basis. So we call it divisible profit. So 24,000 minus 10,800 minus 1,008 will leave you with 11,400. Then with this 11,400, look at what is the sharing basis. Sharing basis is 2/3 and 1/3. So 2/3 of 11,004 should be 7,006. Okay, 2/3. Yeah. Okay. So 2/3 will go to partner A as his share of profit. 1/3 will go to partner B as his share of profit. So if you look at it now, you can see that for partner A, his salary, his interest, his divisible profit, everything will be add up together is 14,600. 14,600 would be his total income that he derived from partnership. And for partner B, his total income he derived from the partnership is 9,400.
Li Ying, can I ask a question?
Yes,
So
yes.
the partner's capital contribution is not 2/3, 1/3, so they can actually don't go by the
It's
interest in the
fixed.
partnership.
It's fixed because there's been agreed.
Mm.
Let me see, where is this? You see the earlier slide? The earlier slide is the example. I cannot move my earlier slide. Oh, see. Let's see. Sorry. Oh, yes. I have to go like that. Where is it? You see here? It's 5%. So these are considered fixed. That means there's agreement that you contribute Like for partner A, 20,000, you will get 5% interest.
What I mean is that partner A contributed 20K out of 36K in the capital. Actually, 20 out of 36 is actually
Oh, no,
55%.
no.
It's
No, no,
getting
it's not that way. The sharing basis is based on whatever the
they agreed.
profits, yeah, the agreement. So it's at this level. Yeah, it's at this level. That means you less out is at 11,400. That is the sharing basis. So these are even the salary, it may not be two-third and one-third. It's agreed on. It's agreed. That's why we call it fixed. Okay,
Because in
fixed.
companies context, dividend is split based on your shareholding in the state in the company ma. So this one you can actually anyhow fix.
Oh,
Don't
this
need
one
to
is
go
up
by
to
your
up.
capital
Yeah,
contribution. Okay.
it's up to the negotiation to say that no, partner A say I give you I have this amount of capital, and what's the interest? Okay, so it's agreed, just like the salary agreed that you'll be paid 6,000, that will be your salary, and it's agreed that 5% of your capital, that will be your interest. So that is the one. Whatever remaining, it could be a loss, if the business is not performing well, will be a loss. So the divisible loss or the divisible profit, then we look at the sharing basis, two-third or one-third. That's why you call it divisible. It's something that can be divided among the partners. Okay, can I move on to the next slide? Okay, okay, so in this slide, we are talking about partnership changes. Okay, sorry, let me see. Okay, change can occurs in a partnership. Okay, so what happened? We look at the assets. The assets are sold, are deemed as sold to the new partners at open market price. Because partner can come in, partner can go out, correct? So there's changes. So what happened to the asset is that it's deemed as sold, okay, to the partner who comes in, the new partners. So for the computation of BA and BC, we will have to compute. Okay, so computation of BABC for partners, the seller of the partnership, and to compute CA to the new partners. So basically, it's just mentioned, partner in and partner out. We may have to do a BABC, and then for the new partners who just joined, then they were entitled to CA on the assets. It's as though they buy. Then if Section 24 is elected, it as though it's continuous, then CA will only be given to the buyer. Okay, next we go on to limited liability partnership. Okay, limited liability partnership is just a business vehicle, to give businesses more option, which one would they in structuring their business activities. So it is a body corporate form by registering under the LLP Act, and it functions and operates as a partnership while it has a separate legal entity. But for tax purpose, we take it as tax transparent. Okay, next, some information on LLP. It's a separate legal entity, as I said. Okay, there will be perpetual succession, and the partner can be individual or can be corporate, and then there'll be two or more persons, no upper limit. It can be as many as they want to. And then, okay, this part on allowed partners liability to creditors of the partnership to be limited, because they're limited partners. So limited partners, just now I mentioned, they're liable to the partnerships that is up to the amount of the contributor capital. So that for that reason, we will have to do some restriction, which will be in the later slides. In the case study, we will see how are we going to do restriction. Okay, similarly for LLP, the filing of the tax return form P is the responsibility of the precedent partner. So just remember, partnership, whether is it general partnership, whether is it LLP, whether is it LP, is tax transparent. First thing, is tax in the hands of the partners. Second thing, the filing of the tax return form is by the precedent partner. Okay, tax treatment, I think I will summarize. It's not a separate legal entity, and it will file tax return just as any other partnership. Individual partner will be share on his share of partnership income, and corporate partner will be taxed on the corporate tax rate. Each partner share of LLP unabsorbed CA and loss and trade loss available to offset against his other income. This is the part where we may apply certain restriction. Okay, even if it's a foreign LLP, it will apply the same. Okay, when we talk about set off of CA and trade loss against other income, when we say other income, means other than the LLP business income. Okay, other income can be the um, rental income. Okay, it's also other income, or the partner his own employment income. So these are other income. So when we talk about offsetting other income, we have to certain terms we need to take a look. Okay, at this moment, you just you just take note lah. Okay, there's such term as that. Okay, later on in the example, I suppose you will understand it better. Okay, so relevant deduction are all those CA losses that allowed against the other income for a YA. So means deductions, okay, that allowed against the other income. Past relevant deduction are all those past YAs deductions that given, not to exceed contributed capital. Relevant deduction restriction. Okay, this relevant deduction restriction is to say that whatever that the deduction that to be given, it cannot exceed the contributed capital of the partner. Then if there's excess of partner share of CA and trade loss over CC, it may be carried forward to offset against future share of income from the same LLP. Okay, this is a good example. Please take note of it. Okay, I try to go a bit slow so that you can understand better. At the same time, also mindful of the time. Okay, I may overshot a bit. Okay. Sorry. Okay, come. Mr. P is a partner of an LLP, and his contributed capital in the LLP as at 31st of December 2021 and 31st of December 2022 is 25,000. So it remains the same. Okay, 2 years, his contributed capital is 25,000. He didn't make any withdrawal of his contributed capital. So it stays at 25,000. 25,000. Okay, important to take note of contributed capital. Okay, so bear in mind, 2 years contributed capital stays at 25,000. His share of LLP, CA, and loss is as below. Okay, so we see that in YA 2022, 31st December 2021, he has 18,000 CA, loss, LLP loss 3,000, and for year ended 31st December 2022, that means YA 2023, his CA is 11,000, his LLP loss is 8,000. Okay, now we take a look, how shall we allow him the CA and LLP loss against his other income? Okay, he has other income of 25,000 and 15,000. How much can we allow? Do we need to do any restriction? Next slide. Okay. This is a very important slide. Take note of it. Okay, remember LLP restriction applies only on other income. So we have to take note of what is the other income. Okay, YA 2022 other income is 25,000. Okay, if you go on to that, if you go and take a look at that, the earlier slide, it states that other income is 25,000. Okay, so 25,000, then we look at CA. Maybe I'll show you again. 25,000 is other income. CA is 18,000. Now the question is, can I less out CA from this 25,000? Okay. Then we have to look at what is the CC. The contributed capital is 25,000. All right, 25,000. So 18,000 is still lower than 25,000. So we can allow the deduction 18,000. Okay, so 25,000 less out 18,000, we got 7,000. 7,000. Then LLP loss. How much is the LLP loss? 3,000. Okay, there again, before you less out against other income, ask yourself, can I less out 3,000 from this 7,000? Go back to your CC. What's your contributed capital? Contributed capital is 25,000. So even 18,000 plus 3,000 is 21,000. So 21,000 is below 25,000. So can allow. Okay, can allow. So we can allow 18,000 plus 3,000, which adds up to 21,000 relevant deduction. Okay, it makes his chargeable income 4,000. Also, come next year, 2023. Okay, again, we put in other income 15,000. Okay, you look at here. 15,000 is his other income. Okay, then we ask 11,000 CA, can we allow against 15,000? Okay, the answer is we have to restrict. We have to restrict. Okay, we have to restrict to 4,000. Okay, why is it so? Only 4,000 relevant deduction is allowable against Mr. P's income from other sources, as his past relevant deduction is 21,000. And the relevant deduction for YA2023 cannot exceed his CC 25,000. So 25,000 is his CC. His past relevant deduction 21,000. So what remains is only 4,000. Okay, so we cannot allow 11,000, but we can only allow 4,000. Okay, to offset against the other income of 15,000. So the chargeable income become 11,000. Okay, so we would have some carried forward already because he has CA of 11,000. Okay, but we only use 4,000, so remaining 7,000 can be carried forward. Okay, and then how about the loss? We didn't even touch the current loss at all, so it's 8,000. So these two are carried forward figure. Then we can see that relevant deduction is only 4,000. Relevant deduction and past relevant deduction, 21,000, add up together, 25,000. It is the capital contribution for 31st of December 2022, 25,000. So this is how we do the restriction. Okay, it's quite clear. If you know that you have to think whether can offset against the other income, and then you take a look at what is the contributed capital. Later in the case study, we will do more of such two more cases of loss restriction. Okay, I move on first. Okay, so these are more of explaining what do you mean by contributed capital. So it's actually in cash, in kind, and then it's not the money that is withdrawn. Okay, most taxpayer has this misconception of contributed capital. Okay, when we said please put in what is your contributed capital as at 31st of December 2022. Okay, they will thought is the incremental, like for instance 31st of December 2021, he has contributed capital 50,000. Then later on in 31st of December 2022, it increased to 70,000. So the contributed capital as at 31st of December 2023 is actually 70,000. It's not the incremental. That means 50,000 plus 20,000, then 70,000. It's not 20,000, but 70,000. Okay, so it makes a lot of difference if put in the wrong contributed capital, because the restriction will be done according to what is the contributed capital that was what that you all have, or taxpayers inform us. Okay, I move on to the next one. Okay, comparison of amount of past relevant deduction with CC. I think just now in the example already show we have to take note of all the past relevant deduction to compare with the CC. Okay, so for if should there be a reduction in CC, then there will be a deemed income. Okay, for this part, you just bear in mind, if the CC reduced in a way that your past relevant deduction be higher than the CC, that would be a deemed income. And correspondingly, this deemed income is actually the trade loss. And if I think I move on to the example, you can understand better why is it that there's a deemed income, and how we do a deemed income, and how we have a corresponding trade loss. go to the next example. Okay, okay. Actually, this example is a follow-up from the earlier one. Okay, remember the earlier one, we have this relevant deduction of 21,000 earlier on, because the contributed capital is 25,000, so it's still within the 18,000 plus 3,000, 21,000 is still within 25,000. So YA 2022, no problem. Okay, come YA 2023. Okay, the earlier example shows that it stays at 25,000, but this example shows that the CC has reduced from 25,000 to 20,000. So there's a reduction in CC. Okay, this slide basically explains the earlier two slides, because earlier two slides, I suppose you may have problem understanding, but with this example, hopefully you can understand better. Okay, so it shows that the CC has reduced from 25 to 20,000 now. So come 2023, as per normal, we will say other income 15,000. Other income 15,000. Okay, we put in. Then CA, how much CA can we give? Oopsie, I keep 1,000. Okay, why is it 1,000? Because now we have become a deemed income, 1,000, because we have over given. Okay, the CC is only 20,000. Okay, but past relevant deduction 21,000. So over given the deduction, so it become a deemed income. Okay, it works in such a way. Okay, you will have a deemed income, and correspondingly there will be a deemed trade loss, because this is indeed a trade loss. So the current trade loss of 8,000 that you add on to the deemed trade loss, in total there'll be 9,000 carried forward loss, unabsorbed loss to be carried forward. Okay, so this example basically show you when there's a reduction in CC, the difference will be the deemed income. The difference between the past relevant deduction and the CC of 1,000 is the deemed income, and correspondingly it will be a trade loss, which add on to the current trade loss, and it becomes 9,000. 8,000 plus 1,000, 9,000. Okay, and it makes the LLP carried forward figure to be 9,000. Okay, next we go on to carry back. Okay, carry back. This is slide 48. Relevant deduction restriction also apply when we do a carry back. Okay, again, look at the CC. CC is the CC that we are looking at will be the CC of the LLP partner as at the end of the basis period relating to the current YA. Okay, there should be an example for this. I think it's in the case study. When we do that, maybe you will understand better. So we look at the CC of the current YA when we think about carry back, when we apply the carry back to the previous YA. Okay, change of business structure. Okay, that is LLP takes over a partnership, or even what happened to it. Okay, so there may be some change, but we talk about CA. Remember, we kept saying about business continuity test. Okay, we talk about business continuity test. So it does not mean that when there's change in business structure, the business cease. Okay, the same business may still be carried on, okay, even with a change in the business structure. Okay, this one a quick one. I go through with you all. When we talk about loss restriction, we always talk about other income other than the LLP, other than the income from the same LLP. So loss restriction, it only applies to other income other than the same LLP. So for that reason, you look at it. Unabsorbed CA, carry forward for deduction against future income of the partner from the same LLP. So we no need to do restriction because it's the same LLP. Okay, the second one, deduction against other sources of income of the partner. Yes, we need to do RD restriction. Okay, the next one, same LLP again, carry back. Yes. Okay, not the same, sorry, it's not, it's against the partners accessible, not the same LLP. You have to do a loss, relevant deduction restriction. And then we move on. Same thing, if it's the same LLP, no restriction applicable. If it's for other sources of income, yes. Okay, so even for unabsorbed trade losses, if it's not from the same LLP, you would need to do a restriction. Okay, move on. Okay. Limited partnership actually is basically the same. As I said, as far as tax treatment is the same, but this is for your knowledge. You just have some features of limited partnership. It's not a separate legal entity. It can consist of one or more general partners or one or more limited partners. For limited partners, there should be one general partners. Okay, cannot be all limited partners. There should be one general partners. And then unlimited liability for limited partners will be subject to, again, to the loss restriction because it's for the limited partner. So tax treatment is the same as LLP, where each partner will be taxed on his share of LP profit as its applicable tax rate. Okay, for limited partners, the same restriction, the relevant deduction restriction would apply. Okay, conversion of general partner to limited partner. So what happened? Suddenly the partner say, I want to be a limited partner. Then this general partner will deregister as a limited partner, and then as a limited partner was subject to relevant deduction rules. And if the limited partner changed to be a general partner, then this limited partner, at that point when he changed to be a general partner, he will not be subject to the relevant deduction rule because relevant deduction rule only applies to limited partner. Okay, so that's it. I'm not sure what's the time now. Maybe we have a short break of, I don't know whether you want a break or we go straight into the case study because I would like to have more time on the case study. Okay, let me see. Okay, I think Jean asked about slide 47. Explain. Okay, maybe I before I answer this, I go to the case study. Maybe from the case study you'll understand better. How is it? 20,000. Why is it? Oh, why is it RD? Okay, I'm not sure whether you want a break, but maybe I would suggest maybe 5 minutes break for you to read through. But no need to set the timer. I will flash the question there. 5 minutes for you all to take a look. Then we work together. Okay. By working together, I'm sure you all will have a better understanding. And please try to participate. You can either unmute and tell me the answer, or you can post it in the chat box. Okay, so I will flash the question. There's 2 case studies in total. We start off with case study 1 first, and I'll flash it now. You will have maybe 5 minutes to take a look, then we will start doing that case study. Okay. Can you see the question? Question 1, Andrew's income for YA2022 and YA2023.
Yes.
I think you all should have the question, but not the answer, right?
Yes.
Okay, good. Thank you very much. Okay, I just put it here for a few minutes. Read it up, and then we will go through the answer. Hello. Okay, I think we better start. I think you all have read through the question. Okay, before I go through this case study one, Jean, you have written a question on slide 47. You're asking, can you explain the 20,000? Why is it that the RD for YA 2023, how is it calculated? Okay, maybe you have the slide with you. If you look at slide 47, you note that the CC has dropped, okay, to 20,000. Okay, previously we have given relevant deduction, or we call it past relevant deduction of 21,000. Okay, the fact that we have given 21,000 past relevant deduction, we will we will deem the income, the difference as the 1,000 difference as deemed income, and then the trade loss is also as 1,000 trade loss. And on top of that, the relevant deduction is no longer 21,000 already. It has dropped because we have deemed the income as 1,000 and the trade loss is 1,000. So we will have to deduct relevant deduction. 21,000 less of 1,000, it will be 20,000.
Why is the YA2023 relevant deduction starting off at 21,000 though?
Because 21,000 is the relevant deduction, past relevant deduction. Past relevant deduction. Okay, relevant deduction 2022, 2022, the past relevant deduction is 18,000 plus 3,000, 21,000. We have given, but in 2023, we know that it goes to 20,000, the contributed capital dropped to 20,000. So the relevant deduction would have to reduce. Okay, so we have reduced it. We so-called reduce it by doing the deemed income and the trade loss and the deemed trade loss. It is something that it may not be really can understand, but it is something that you can just take note of. When there's a reduction in CC, there will be deemed income, deemed trade loss, as well as the relevant deduction reduced by that amount. These three things to take note of. Okay, maybe if I go on to the case study, maybe from that you have a clearer understanding on how we look at the contributed capital and the relevant deduction. Okay, I shall move on now. Okay, so we have this Andrew. Okay, Andrew's income for YA2022 and YA2023 are given below. Okay, then you look at it, you got employment income, which is the so-called other income. Okay, so for both years, he has employment income. And he's also a partner of J&J LLP. So for both YAs, there is LLP share of loss. Okay, 1 year is 11,000, another year is 35,000. And on top of that, there's also CA of 4,000 and another year is 8,000. Okay, contributed capital, 25,000 for the first YA and later on increase to 45,000 in 2023. Okay, what are you supposed to do? Compute Andrew's accessible income and relevant deductions for YA2022 and YA2023. Okay. Okay, now we're going to compute. Okay. Okay, first thing we take a look. LLP other income. Anybody wants to help me with it? What is LLP other income? It's actually in here already. LLP, there's other income. Besides employment income, there's other income.
1,000 rent.
That's right. Jean, very good. 1,000 rent. Okay, so it's other income, we put it in. The whole question is, can we allow the CA and the loss to offset other income? So we put the other income first. 1,000. Employment income. There's an employment income.
120.
Yes, correct. Very good. 120,000. Yes. Okay, now the next thing, you always ask yourself. CA. CA is 4,000, right? 4,000. This 4,000 CA, can I allow this 4,000 CA offset against other income?
Yes.
You have to take a look at why is it so?
Because
must
the
know the reason.
contributed capital still 25,000.
Yeah, very good. This is important. You must know why. Okay, correct. So always put contributed capital first, so it's easier for you. Okay, put here contributed capital 25, then you can see clearer. So you not ask yourself 4,000, definitely can. 4,000 is below 25,000, so you put here 4,000. Okay, so your relevant deduction, because you're deducted already, so your relevant deduction become 4,000. Okay, then 120 plus 1,000 minus 4,000. Somebody can tell me how much is it?
21,000.
Huh? Minus 4,000, huh? Minus 4,000.
117.
Yep, correct. 117. Correct. 117. 117. So 117 is just simply calculation, okay? 120 plus 1,000 minus 4,000. Okay, now LLP loss. LLP loss. I go up again. LLP loss. What's LLP loss? 11,000 LLP loss. Ask yourself again, can I use this LLP loss 11,000 to offset against this 117,000?
Yes.
Yes.
Why is it so?
Because it's still within 25,000
What is within 25,000?
contributed capital.
Okay, to be precise, it's because 4,000, you must take consideration 4,000. 4,000 plus 11,000 is 15,000. This two, 15,000 is still within 25,000. Okay, so remember, both. So it makes the accessible income
106,000.
correct. Good. Okay, good. Okay, then of course this one you all would know lah. You already utilized already, so zero already. Okay, zero already. Okay, so this one zero. Okay, relevant deduction very important. You must know how much you have deducted. How much is it?
15,000.
Yes, very good. Hey,
Hey,
the rest of you, are you following? Because I only hear Jean's voice. I suppose you are okay with it, right? Okay, this is
yeah.
very important. You must know. Okay, thank you very much. Okay, good. Yes, good.
Sorry,
Anything you
sorry. Relevant deduction is 15,000, not 10,000. Because it's
15,000,
carry forward.
15,000. Relevant deduct 4 and 11,
Oh
15.
no, because I'm looking at the carry forward, so I thought it's
No, no,
a
no.
no.
Oh, no,
So
no,
it
no,
must
no.
be this year.
Yeah. So
Okay,
it's like
okay,
that.
okay,
So
okay.
because this one just started business, so it's the same. Okay, 15,000. Okay, get it? Okay, you get it. Very good already. Okay, now we go on to the next YA. Okay, what is the question? The question, yeah, okay, 2023. Okay, next YA. Again, look at other income. Okay, come, somebody tell me.
2,000.
What is the other income?
2,000.
2,000.
That's right, because this is the LLP other income. Rental income?
Huh? Rental?
Oh,
No.
No,
sorry.
employee is it?
Employment income. Employment income.
20. Yeah.
23,000.
Employment income?
23. 23,000.
23. Yes, correct. Okay. Now, okay. Again, when you talk about LLP, CA, go back and take a look. What is the LLP CA 8,000. Ask yourself again. Before you ask yourself, I better give you the contributor capital. I give you a hint already. Contributor capital increased to 45,000.
Yeah.
Contributor capital must take into consideration past relevant deduction. Past relevant deduction, 15,000. Now you ask yourself, can I give the 8,000 or not?
Can.
Why?
You only use 15,000.
15,000, even you use 8,000,
30K left.
even you use 8,000, is still less than 45,000.
45. Yeah.
Correct? Okay,
Yes.
good. That is the correct understanding. So 8,000. So you give 8,000 we give. Okay, then now we see what is the remainder. Remainder 17,000. Okay, how much is your LLP loss? How much is your LLP loss? 35,000, a lot. Okay. Do you need to use all 35,000?
No.
No, because you just need enough to offset 17,000.
17,000.
So you ask yourself, can I use 17,000?
Yes.
Yes.
I always ask, why is it that you can use?
Mm,
The calculation, 45,000
Okay. Relevant minus 15 minus 8
correct,
minus 7.
17.
Yeah.
Still within, right? Okay.
Yes.
Yes, very good. You must know how to minus and see that it's still within. Then it's correct. Okay, correct. The rest following, very good. Okay, then we have accessible income 0. Okay, this one, let me see. Okay, this one will be 17. So always log in your relevant deduction. Okay, so you can see at one glance, you know how much was deducted, how much is your CC. Okay, unabsorbed CA carry forward should be nothing
Yeah.
because you
0.
utilize all. This one should have something. Person 35,000.
Yes.
35,000, but we only use 17,000.
18.
18.
Correct. 18,000. Good. Okay. 18,000. Okay. Now we see. This one is 25.
Yes.
25. Okay. How much have you so far? How much have you what's the relevant deduction so far? What is the
Relevant.
total relevant deduction?
Oh, total.
45,000
45 is contributed capital.
40.
minus
40 is it?
40.
Yes.
So
40.
5.
You know how to get 40? It's 15.
25 plus 15.
Yes, that's right. Very good. Okay, so we have relevant deduction 40,000 for YA2023. Are we happy with it? Are we happy with it? Is it okay?
Yeah.
Okay, huh? Because the contributor capital is 45. So we are very happy with it because it's within the contributor capital. Okay, now we see the next question, I think part 2 of the question. Andrew would like to carry back. Okay, so this question involves carry back. Any unabsorbed CA loss for YA2023 to YA2022. Compute the accessible income for YA2022 after the carryback and the relevant deduction. Okay, so what it means to say is that Andrew see that he has this 18,000. This carry forward. It can carry forward and it can carry back. Then he see he has accessible income of 106. He wants to use this 18,000 to offset against this 106. Can or not? Okay, we do together. Okay, so basically from here until here is the same. Okay, so now is whether can use 18,000 offset the 106. Okay, just flash you all. It's the same as just now above, so no difference. Okay, no differences. I just show you all. So this one is 4,000. I will stop at the what? Stop at here. Stop at here. Okay, so this is what happened here. 106. So he knows he has 18,000 loss. He wants to offset against the preceding YA2022's income, 106. Can we give it to him? Always ask yourself, what is the contributor capital? And which contributor capital we're looking at? Remember that one slide we say the current one? Look at 45,000. Okay, look at 45,000. 45,000 is the contributor capital as at 2023. So 45,000, but we already have taken or utilized 40,000. So do we still have room for it?
5,000? 5,000 left?
Yeah, good. I'm waiting for some answer. Okay, they're very good. So we still have 5,000, right? Okay. So when we have 5,000, what does it mean? How much can we give then?
5,000?
Yes, we cannot give 18,000. Okay, we can give 5,000 only. So important, everybody knows why we give 5,000. It's because of this. Okay, this is just the restriction is just a rule. It's a rule that you need to understand. Okay, so the rule states that you have to look at the current. Sorry, 45,000. What have you utilized before? 40, and it cannot be more than 45,000. So the max we can give is 5,000. So that's how we have this 5,000. Okay, so far okay. Then the total will be the accessible income will be this one, 106 minus 5,000. You get this. Okay, but this is as per normal. Okay, as per the 2022 that you have been doing earlier on, and then now you will see here 15,000 contributed. Previously we give 15,000, right? Okay, then we give any additional, we give additional 5,000, right? So total we give 20. Okay, understand? 15,000 we give originally, the earlier. Then we give another 5,000. So total relevant deduction is 20. Okay, can? Okay, now it's almost 1:30 already. I think I go on to the second case study.
Sorry, I have one question.
Yeah, sure.
If we go beyond 2023 and in 2024 I decide to move out of the partnership, which means my capital would be reduced to 0.
Okay.
Yeah.
The thing is that if you cease partnership, there will not be any relevant deduction already. Okay, when it's come to cessation.
No, I understand. But how about the past deduction? Since I move out, which means my my capital is 0 now. So you are looking at the year end.
Okay.
Not so.
Okay.
What would happen to the past relevant deductions? Will you take back from me?
No. Okay. Remember, got one slide we say okay, we take it as he still stays as a partner. It's just that maybe his CC reduced so much until it becomes over past relevant deduction is more than the current CC income 2024. Remember the earlier slide, we got one slide where we show the slide 47 that Jean was asking. Okay, so in circumstances where the reduction in CC is so huge until the relevant deduction is more, then we will come in the deemed income in YA 2024. It will not be in 2022 and 2023. Okay, you look back at slide 47, you will have a clearer understanding. To the extent that it's so low, the CC maybe up to maybe $1 left, then you have to, whatever that we give, but in that YA 2024, it will be a deemed income. Okay?
Sorry, if it is a deemed income, so it means basically you are taking back, right? Everything
Oh,
what you
yeah,
have
right,
given.
yeah,
Yeah.
right, yeah,
So
right.
then there is no point of even giving all the deductions, because
Yeah.
one day someone needs to close. Yeah, someone needs to decide to close. If he or she decide to close, you will take back all the deductions. So why you are in the first place giving all the deductions
We
when
give,
you will take back?
yeah, we give back because we're following the deduction rules. Earlier years is within the CC. But once the CC dropped so much and we have given it and it's exceeded the CC, it will have that effect already. It will have that effect. This is basically reduction, it's a restriction rules, okay, which we are following. Okay.
But it doesn't make any sense actually. At the end, it doesn't make any sense of giving deduction at all.
Because limited partners, they are liable up to the CC. Okay, so whatever instance, you have to differentiate a limited partner and a general partner. A general partner will not have such restriction rules. Okay, you incur loss, okay, give it to you the whole thing. But limited partner doesn't work that way. Okay, there must be some difference between a limited partner and a general partner. There is a restriction because they are liable up to the contributed capital.
Okay. Thank you.
There's a bit of difference depending on your personal tax rate much later, or maybe you retire, you close the partnership.
That one, yeah, that's another thing. But as long as your status is different, there must be a different tax treatment already. Okay, can I move on to the second one? Thank you very much that you're clarifying. At least you're thinking, and it's very good. Okay, I go on to the next one. I stop sharing this one. I go on to the next one. Okay. Okay, question 2. Please study. Are you seeing?
Yeah.
Okay, good. So sorry, I overrun a bit. Okay, I am trying my best. Okay. Okay. Can you all see? I think I will just read the question and then we work together. I don't think I will give you all time to 5 minutes time. I think I'll just read through. Okay, come. Okay, Shanti comments LLP business. Okay, with a friend in 2021, her income as follows. Okay, we can see there's employment income. We can see that there is loss. First year LLP loss. 2022, there's a 53,000 loss. But when it comes to YA 2023, she has LLP profit. Okay, there again, look at the contributed capital. Okay, now we work on the 2 questions. First question, compute Shanti's assessable income and relevant deduction for YA 2022. Next question, compute Shanti's assessable income and relevant deduction for YA 2023 after carried forward of the unabsorbed CA and loss. Okay, so earlier question, carry back. Second question, carry forward. Okay, so we cover everything. Okay, come take a look at YA 2022. Okay, you'll notice that the look is a bit different. Okay, it's because there's a second year YA 2023, there's a profit. Okay, so when we talk about offsetting the losses and the CA, is only against other sources of income, and the relevant deduction also against when it comes in because there's other sources of income. So when it's same LLP profit, there shouldn't be any restriction. There shouldn't be any relevant deduction. Okay, relevant deduction restriction, there shouldn't be. So that's why, because there's a profit there, the look is a bit different. We have to offset it first against the LLP profit before we consider other sources of income. Okay, come, let us work 2022. So we see this is just simply put in numbers as per the question. So there's not a profit, it's a loss, so it's 0. Okay, then we see there's nothing because it's the first year. Okay, can somebody read to me what is the CA? What is the CA for?
13.
Yeah, correct. Good. 13. Just put it in. Okay, then okay, then okay, the loss don't have, huh? This one. Okay, then we have current
Loss
loss.
53.
Yep, correct. Okay, so we add up all together. Add up together. So we know that that is this 66. Okay, so 66 is the loss. Everything in. Employment income, how much was it that she's getting?
39,000.
39. Yep, good. Then okay, there's nothing here because it's already computed here already, so there's nothing. We already computed up. Okay. Zero current less 13. Okay, we fetch it down again. Fetch it down from here. Oopsie, this one you can see already. Okay, never mind. Okay, this one 13. Okay, 13. Okay, now we see 39,000 less 13,000. What is the contributed capital?
50.
Contributed capital 50,000. Okay, 50,000 current loss. Current loss 53. 53 loss here, 13. So we have this, we left with 26. We can allot 26 because it's still within 50,000. Okay, understand this part? 26, 39 minus 13, 26. 26 is still within the 50. Okay,
But why is
because
it a loss? The it's
it's
20,
here, it's here,
39 is income minus 13.
53. Can you see 53 LP loss?
Yeah, but you're under employment column already. What?
Yeah, we want to offset against the employment. We want to offset against the employment.
29, positive 29 minus 13K, isn't it positive 26?
39 minus 13,000. What do you have?
It's a
26.
positive 26,000, not a negative 26,000.
Yeah, we want to utilize. Now is the
Oh,
utilization.
okay.
Okay, so we utilize 26. We don't need to utilize 53 because it's only left with 26. Okay, get it? Okay, good that you clarify. Okay, carry forward 0. Nothing already, all utilized for the CA part. 13,000 all utilized, so nothing. Okay, this part, how much left over? 53, right? Is it 53? Let me
Yeah,
see.
27.
53. 53.
27 left.
27. Correct. So it's 53 minus you utilize 26. So left is 27. Okay, 27. Okay. Then you add this two. We want to see what is the
39.
39. 39. So we are happy with it, right? Because 39 is still within 50,000. Okay. Then we see what's the next question. Okay, now Shanti want to carry forward. Carry forward. Okay. So carry forward there again, we plug in all the figures. Okay, can help me with it. What's that? It's a profit, right? Plug in the figures for me. What is
20,
LLP?
28,500.
20,500. Okay, any carry forward here? Nothing, 0. CA, nothing. Current year, CA, can read to me?
CA 5,000.
Yep. 5,000 current year CA. Okay, this loss brought forward 27 from here. Right?
Yes. How much?
Okay, can. Then this one, nothing. Okay, then we as I said, because it's a profit, this loss offset the profit first. Then we get a figure. So once we have this figure, it's still a loss. It's still an amount to be offset against the other sources of income because it's more than the profit. The CA and the balance brought forward figure more than the profit, so it comes out still a unabsorbed LLP, CA or loss. Okay, so we have it here. Then we plug in the employment income. So employment income.
Have.
Yeah, got.
40,000.
40,000. Okay, can. So we have 40,000. Then we look at the. There's nothing here. Okay, it's only here because everything become 3,005. So it's 3,005. Okay, can we allow 3,005 or not? Okay, I give you the capital contribution. Always put in the capital contribution, then you know. Still remain at 50. Can, right? Because we only utilize 39 ma.
Yes.
Correct?
Yes.
39? Correct. Yes, very good. Then it's like that. Then we put in here. So relevant deduction is 35. Okay.
Current
So all this
CA
is
5,000.
okay. So 40 minus 3,005 is 36,500. This one remains at 35. So this one quite straightforward in that sense. Okay. So total 39 plus 39 is 42,500, still within 50,000. So we are very happy with it because it's all within the capital contribution. Okay, Ken? Okay, so can I just quickly wrap up certain things because I think there's one question on I just now I saw there's one question that says that sole proprietor is the owner is a corporate. Okay, if the sole proprietor is owned by a corporate, it will makes it a corporate issue, a corporate tax. Okay, it's no longer under individual, so it'll be under corporate tax rate and is under the corporate tax module. It won't be covered under here. Okay, you take it as though it's a corporate tax, corporate entity. Okay, I think there's any other question. If not, I wrap up. Could you just give me 5 more minutes? Just wrap up quickly. What have we been doing so far? And then yeah, just give me a minute. Let me see. Okay, so this session for this session, we have covered business expenses. Okay, important you have to know what are the allowable business expenses, and for that you have to take note of section 14, section 15. Okay, bear in mind private car, okay, is something that we don't allow except PHC. Okay, PHC driver's income, they can claim this private car expense. And also remember the FEDR, the fixed expense deduction ratio given to 3 groups. Okay, you just need to know the 2 groups because the PHC and the commission. The other one on the delivery that's only effective in YA 2024, and you will not be tested on 2024. You'll be tested on 2023's condition. So remember what are the rates and what do you mean by FEDR? FEDR is actually the expenses. That means it's in lieu of actual expenses. It's either or. If you opt for FEDR, then you no need to compute actual expenses. If you think FEDR rate is too low, my actual expenses is higher, then you go for actual expenses. But commission agent cannot if it's 50,000 and above. It has to be actual expenses, cannot FEDR. Okay, that's something which you need to know. And also you must know how to compute just a basic thing you need to compute adjusted profit of the self-employed. That means you know how to add back what are the disallowable expenses. And for LP, loss restriction, I think you shouldn't have a problem. The 2 case study, I can see that you understand, at least understand how it works. Okay, and yeah. Then remember also another thing is that for self-employed person, their MediSave contribution is compulsory if they are Singapore citizen, Singapore PR, and also must derive net trade income more than 6,000. Okay, and I have already explained on the filing requirement for individual precedent partner. He will need to file his own Form B, declaring income from all sources, and also the partnership form. Okay, because he's a precedent partner, he will need to complete the partnership form, declare partnership performance, how is it being shared among the partners, and the partner share of allocation. So if it's just an individual self-employed person, it will just Form B. Okay,
Can we look at your answer just now? The last one, I'm just wondering why this current CA 5,000 is not reflected in the under employment income.
Sorry, the case study 2, is it?
This one, the later, yeah.
Case study 2.
The answer.
The answer you want to flash again, is it? I thought I just pushed it down then. Yeah. Okay, which part of it?
You see the 5,000 CA, right, under employment income, why is it not reflected?
5,000, sorry, this one, right? Employment income.
5,000 less LLP current CA line, right, is 0 and beneath the 3,500. Why is it not reflected of 5,000 CA there?
Oh, because it's taken account here already.
But then
You see,
on the left side, it's taken account top and bottom for the CA.
no, because this one less out already. 5,000 less out against 28. This one 13 and 5,000, nothing to less out.
Okay,
Nothing to less out. I get it. Because the reason I do it is because I want to show you all LLP profit, you don't need to do relevant deduction. Whatever 5,000, 7,000 automatically off less out against the profit. Then you have this 3,005. So you don't put again 5,000 or 27,000. Already less out against the 28,500. Okay, thank
Sorry,
you,
sorry.
class.
So,
Yep.
Leon, just confirm,
Mm.
right? So we need to compute basically the trade first, because it's a 5,000, 27,000 is belong to the trade, basically LLP profit. So we can deduct everything. Then
Yep.
after that, if those capital contribution only apply to the other income. Is that the reason why you
Yes.
put it?
Yes, yes.
Okay,
You must
okay.
get the principle right. Get the principle right. Okay. The principle is when we talk about relevant deduction, is always against other sources of income other than the LLP. So if the LLP has profit, there is no relevant deduction. Okay, you don't bother already. Whatever losses, previous year losses, you can offset against the profit of the same LLP. That is why it's been presented in such a manner to show you 5,000, 5,000, 27,000. I don't even bother about the CC. I just give it an offset and it became a loss here. Then the next moment you look, 3,005 cannot offset against other income. That is the part where we will apply the relevant deduction. So the example will show you the principle of this relevant deduction. On how we apply it is only on other sources of income.
Sorry. Can I have one more question?
Yeah, sure. Okay.
For question one, right? Because
Mm,
we want to go to carry back the for
mm,
YA222. So we're looking at 45K for the 45 for the capital contribution for YA223, right? Would there be an example where the 45K is like so much, like let's say 60K, right? Then you will burst the contributed capital in YA2022.
Sorry, 45,000 is capital contribution, right?
Yeah, capital
Yeah.
contribution. So let's say if it's like 60K, right?
Uh,
Then because we have the 18K of to carry back for YA222. So
you,
but in the YA22 is like 25K. So will
you,
it burst?
yeah, that's why you got to go back to carry back rules. Carry back rules is up to how much? There's a rule to it, right? You can
100, is
only
it?
utilize, yes, you can only utilize a certain amount and up to the accessible income. So you cannot be carried back until you become a loss. You get what I mean? You carry back up to the accessible income, up to the accessible income, and up to 100.
Oh, okay, can.
Can get it? Oh, good that you're
Oh,
asking.
so sorry. Can I
Okay, I'm
clarify?
so sorry that I overrun. Okay, I'm really very sorry. I try my best to keep it at 1:30, but I think you all need to clarify things, which is very good. And so the questions are all coming in. And yep. So yes. So yes, I wish you all the best.
Hi, sorry.
Is somebody trying to talk? Okay.
Can I just take a quick look at the answer for case study one just now? I missed it.
The answer, okay, Tax Academy
Okay,
will
thank
give it you. And yeah, so don't worry, the answer will be given.